Good morning, everybody. My name is Sam Isaacson. I'm the president of Walker Dunlop Investment Partners. So Walker Dunlop Investment Partners is a wholly owned subsidiary of Walker Dunlop, which is a publicly traded company. Walker Dunlop is one of the largest commercial real estate finance companies in the U.S. They have basically three primary businesses: multifamily finance. We were the #1 multifamily lender last year in the U.S. Capital markets, we were the #4 commercial real estate lending company in the U.S. last year, and then institutional sales. And so we are in the investment management arm of Walker Dunlop and a wholly owned subsidiary. So Walker Dunlop Investment Partners is, as I mentioned, a wholly owned subsidiary of Walker Dunlop. We're the investment management arm. We have $1.3 billion under management. We invest both on the debt and the equity side through a series of commingled funds and SMAs. So up and down the capital stack, and then across really all commercial real estate sectors, focused mostly, almost entirely on kind of middle market US commercial real estate. So at Walker Dunlop Investment Partners, the way, as we continue to evolve as an investment management business, we've invested a lot in risk analytics and risk management. And what I mean by that is we're investing quite a bit in risk mitigation and risk analytical software and data, as well as other tools and other ways of evaluating the different risks. I mean, primarily there are kind of 5 main kind of big risks that we look at in commercial real estate: economic risks, liquidity risks, political, legal, environmental risks, business and management risks, and then financial risks. And those are really kind of in descending order from things that you can least control to what you can most control. And so we use a variety of different tools to evaluate those different risks and looking at different data. Some of it's more predictive, and some of it's more analytical in terms of how we have to evaluate the data. And obviously, things like political risks are a lot more subjective, and versus if we're looking at return expectations, or really more looking at kind of rental growth or vacancy growth, that's much more predictive based on analytics that we use. So really, we look at, in terms of the types of investments that require benefit from risk analytics, it's really all investment types. So we invest, as I mentioned, up and down the capital stack. So we're investing on the debt side, both as in kind of senior debt positions, both on the permanent and the bridge side. We're investing in mezzanine positions, preferred equity positions, and then joint venture equity positions. All of those investments require risk analysis. Value add, opportunistic, and highly structured, and debt, candidly, are all kind of replete with various options, and there are various factors that affect the risk. And it's really what we're trying to do at the end of the day is hone in on what are the 3 or 4 key risks in an individual deal that are going to affect the outcome of that deal in a negative way. And it's especially important today when markets and commercial real estate are approaching all-time highs, and there's a lot of uncertainty in the broader environment. So specifically, the types of risk management tools that we use at Walker & Dunlop, just to get a little bit granular, one example of that would be we use Monte Carlo. And Monte Carlo is a simulation technique that basically can kind of hone in on a few different variables and really analyze the return expectations for an individual investment based on, one or two or different variables. And we spend a lot of time looking at that on a micro level. So when we take a step back and we look at the broad risks for individual real estate, as we're underwriting the deal, and as we've kind of once we've gotten through the macro top-down approach to looking at how we invest, and as we're doing the bottom up, we start to look at what's really impacting. For example, exit cap rates, and generally they actually are negatively correlated with rental growth rates. So there's things like that we're manipulating to kind of see how that impacts the overall transaction returns, investment returns. We look at risk management models to evaluate leases, for example, as well, analyzing how does the lease duration on a particular deal, the blended lease duration, how does that impact the value of the real estate at the end of the day? So these are some of the things that we're using to kind of look at risk specifically at a very granular level. I think, and maybe one more thing I'll add is that, for example, in when we're looking at expenses, the greater the volatility of the expenses, whether it's taxes, because we have the tremendous amount of uncertainty around the political, the particular submarket or particular market we're investing in from a tax standpoint. That's, if there's a bunch of uncertainty there's volatility around the tax, the pro forma taxes, for example. We're evaluating that and how that could potentially impact the outcome of that investment. So, and one of the questions might be, whether or not Monte Carlo has too many assumptions when you're looking at an individual investment. And the short answer is no. I mean, you have to be careful about not introducing too many variables when you're doing this kind of analysis. But what Monte Carlo really does is it helps make hidden assumptions extremely explicit in terms of the impact on the investment. And it really, helps, candidly gives our credit committee and gives LPs a great understanding of the risk and promotes transparency on individual deals. For example, leases, again, going back to leases are an example of how risk analytics can inform valuation and change the path of a negotiation. For, let's say we have a lease with a 5th-year option to increase the contract rent to market. Even if the market consensus is that rental growth will be 0, as long as there is rental growth volatility, that lease option has value. And another thing is just looking at a negotiation process itself, whether we are selling an asset or we're negotiating a joint venture agreement with a partner. There are a number of instances where, whether in any sort of negotiation process, the two parties are getting hung up on a particular item, and a lot of times it has financial ramifications. One of the things that we've started to do is to really plug that into our models and say, how does this particular item actually impact the outcome of this deal? Is it really something that we should be arguing over, or should we be arguing more about a detachment point in a capital stack, or more about some other sort of negotiating point that actually the other party isn't focused on, and that actually has a bigger impact on our investment? So as we've, one of the things that has been particularly concerning in this COVID environment that we've been has really prompted us to focus more on risk analytics is that we are in an environment where many investors, including ourselves, at the beginning of COVID, really thought that we were going into another GFC. That has not played out to date in commercial real estate. I mean, certainly hospitality and retail have been impacted in a pretty dramatic way, but certainly we haven't seen the wall of foreclosures and the distress that potentially could could have happened, and maybe it still does, but I'm not saying one way or the other at this moment. But what's really concerning right now is that cap rates, generally speaking, particularly in certain sectors, whether it's multifamily or industrial, have continued to compress. And yet there's more uncertainty, broadly speaking, as it relates to NOI going forward in the future. And so that's why we are spending more time on what are the assumptions and what really could impact NOI in a negative way going forward, because NOI is expensive. Cap rates are very, very tight, and we want to be very careful about taking too much risk on how NOI is projected to grow going forward. I think one of the things about real estate, it's still a very illiquid and potentially not entirely and completely understood asset class. And so some of the risk analytics, including the use of Monte Carlo in real estate, continues to be a work in progress. And I certainly don't mean to cast aspersions out into the marketplace against any of our partners or any of our investors or our peers. But our observation has been that risk analytics and the use of risk analytics and the different data is evolving in real estate. And part of that's just a function of real estate, again, being an illiquid asset class, and the data around real estate continuing to improve, continuing to get better, but that it has not, a lot of the data has been really over the last 10 years, and I guess looking back maybe over the last 20 years is when a lot of the data has become available. And so what we've observed and what we see is that it's still, a lot of the data is still misunderstood. There's still a lot of anecdotal kind of evidence and anecdotal methods of investment within real estate. And so what we are doing at WDIP is really trying to stay ahead of the data and really get scientific and more analytical on a lot of the data that we do have access to, and having that really drive our investment decisions. So WDIP is very committed to this new approach. We believe that risk analytics really should be used throughout all aspects of real estate investing. Many times there are a lot of times there seems to be a disconnect between how the industry or how our partner may view a particular investment and what the data really shows. And so some of this is an education from our standpoint, looking and demonstrating, and in many cases, the data actually supports some of the soft science in real estate. And so it's really, I guess, one, the data is getting smarter. We are investing a lot in artificial intelligence at the broader, kind of within the broader organization. And as that artificial intelligence continues to improve, the data is getting better, and we're able to then defend some of our positions that are a little bit different than the conventional wisdom within real estate. So what I think is really going to be interesting as we continue to develop these risk analytical and predictive tools is that it's going to help us anticipate market changes. And the way it does that is, at the end of the day, real estate, fundamentally speaking, is really about people, and it's about demand. And being able to pull the right data that is better at predicting shifting demand is really what we're trying to spend a lot of time and energy and money getting better at that type of analysis. One thing that's been kind of interesting to see is that as we've looked more at the data, for example, a lot of foreign institutional capital in particular has historically favored trophy assets in gateway markets within the US. The data actually demonstrates that the risk-adjusted returns for those type of investments are less than a risk-adjusted return for a smaller market with a stable but growing population versus a more of a flat population growth in a gateway kind of CBD market, for example. So going a little bit granular to the deal level, and the way that these tools really help us achieve superior performance is that really in any deal, there are usually five, I said three before, but five kind of significant sources of uncertainty, whether that's market rent growth, exit cap rate, whatever the case may be. What you have to really do is hone in on what we're trying to do within real estate is you're trying to take advantage, candidly, you're trying to take advantage of the fact that it's an illiquid asset type or asset class, and the data is not completely transparent. And so what you're really kind of manipulating and what you're trying to do is have better data and then leverage the lack of transparency within this kind of liquid asset class to look at a particular asset within a submarket, and maybe it's you're buying it at a better basis, you're seeing some sort of additional upside because of some sort of trend that hasn't become known in that market. Another way that this helps us is that it really helps us from looking at leverage. What's the right leverage that we want to put on a particular asset within a particular submarket? Maybe it's a high growth market, but there's a fair amount of volatility in that market. So it benefits us to be able to know that, so we know what the appropriate leverage is that we should be putting on there in the event that market takes a little bit of a dip. And it also helps us, in that same market, if we know that about the volatility, if we're holding an asset that maybe has taken a little bit of a hit, it helps us understand what the appropriate time is to exit an investment. So broadly speaking, given the current climate and our kind of broad analysis of risk within U.S. commercial real estate, it has changed our direction a little bit, and we are a little bit more risk off, generally speaking, within our fund and SMA vehicles. That goes back to my comment about NOI. We believe that that NOI is overpriced right now, and so we are taking a little bit more of a risk-off approach, other than if we are more on the opportunistic or value-add side, where we feel like we can actually manufacture NOI through a repositioning business plan or a ground-up business plan or the like. So looking kind of out a little bit further as COVID, kind of beyond COVID, and as we continue to kind of move forward in time, we have the benefit at WDIP and being part of Walker Dunlop, literally see hundreds of billions of dollars of deal flow every single year. And the more our data and our investment analysis becomes much more structured and and the data just becomes more accurate and better. With all that volume coming through our investment platform within kind of middle market U.S. commercial real estate, the opportunities are really, really tremendous for us to be able to find alpha within the kind of flow of just transactions that we see. It's really tremendous on the one hand, and it's also, I guess, just to speak for a moment on the macro level, we are in a very choppy environment. We don't see a broad kind of wave of foreclosures or distress coming at the moment, but certainly as a lot of the kind of COVID related disruption kind of works its way through commercial real estate and the pockets of that, we believe that we're going to be able to take advantage of a lot of those opportunities because we've spent a lot of time in this kind of risk analytics. Yeah, so just to kind of wrap up, I appreciate everybody listening in. Happy to have further conversations one-on-one, or you can reach out, take a look at our website, but happy to have one-on-one conversations or answer questions specifically about anything that this discussion may have prompted.